Hey guys, my name is Ruben Dante, and today I'm going to go over the different Greeks, and this one will be Vega regarding options trading. Anything that you do in the financial markets can be risky, and you can lose all or more of your starting capital. So nothing I say is a buy, sell, or hold recommendation. With that being said, options is one of my favorite asset classes, if not my favorite for now. Out of options, futures, and forex, I don't love crypto. And not really any reason for me to trade penny stocks. So with that being said, I will go over Vega. So Vega is probably one of the most important, and I would argue oftentimes the most important Greek when it comes to options trading. And Vega basically means how volatility will impact the call or the put of your option. So let's say here you want to buy the ACN call again at 150, and it's currently trading at 154 or so, and it's currently $4.70, which is pretty, if you're buying it, it may be pretty well priced, but it's about to expire, which is why it's not fantastic. With that being said, the Vega is how how a change in volatility will affect the price of the stock. So if you're buying or selling a stock, Vega or volatility will affect it differently. Usually, when you are buying a call or a put, you might want to buy it in lower volatility, because as volatility rises, when you sell it back, or risk might change. And so, for example, if you're selling an in the money or a deep in the money call, for example, and it's during high volatility, you bought it for whatever reason. As volatility decreases, the chances of it expiring in the money or expiring in your favor increases or decreases, depending on whether you're buying or selling the stock. So in a deep in the money, if volatility decreases, that might significantly affect your options premium. So if it's moving in your favor, as far as the stock goes, the delta is moving in your favor. If you don't know what delta is, I did do a video specifically on delta. But you're losing money. It could be because you have either a negative, obviously the negative theta, which I'll make a video for, or the Vega. If volatility decreases, even though it's moving in your favor, it might be less likely for it to expire in the money and more likely for it to expire worthless if you were, for example, selling a deep in the money call. Inversely, if it might be different if you're selling an in the money or out of the money call. When it comes to puts, higher volatility could mean that if you sold the put, it might be more expensive if you want to buy it back, because it's now a riskier possibility that you might have to be assigned or whatever you were selling the put. And if you were buying it, it might increase in value as volatility rises, because it could be that much more likely that the put that you bought will have then intrinsic value. So if you buy the put at 150, let's say, and volatility dramatically rises for 2 months from now, let's say, it is that much more likely, the more volatile it is, that it will expire at 145 or something like that, by which then you would be in the money. The more likely it is, the more expensive it might be to either buy it too close, a put that you sold, or if you bought the put at 150, it might become, if you wanted to sell it before expiration, you could maybe sell it for more money, as now it's a likely higher possibility that it'll expire with intrinsic value. So that's generally how volatility or Vega could work in your favor or against you, depending on whether you're buying or selling the call or the put. So anyway, guys, I hope this video was helpful. If you have any questions about the other Greeks, I made a video specifically for each one of them. And like I said, it's up to you to put it all together. Thank you guys, and have a great day. Bye.